Hello everyone, today is Tuesday, June 6th. This is your USA Gold Weekly Review and Outlook. Throughout the summer months here, we're going to kind of be on a more sporadic schedule, vacations and otherwise. So just kind of bear with us as we release these videos, maybe more every 5 to 7 days. Not necessarily always on Fridays anymore, so just kind of keep on the lookout there. But that being said, I wanted to visit with you this week. Gold is charging near 1,300 right now, about 12.95 as we film the video. And then silver also headed higher, although silver remains a little bit behind gold. It's a little bit lagging still. The ratio is in more like the mid-72s. Got as weak as 75 to 1 at one point, which was a pretty glaring undervalued condition for silver. We talked about that in the last video. But all that said, both metals look really good. This charge looks a little better than the last charge, Pete, I'll have to say.
Yeah, and we in fact did eke out a new high for the year today, about $1 higher than the April high, but nonetheless, it's technically significant. We'd like to see some upside follow through, obviously, but 1,300 looks, 1,300
right there.
looks pretty attainable for sure.
It does, yeah. More momentum this time. Took off from a little bit higher level after that last consolidation down around 1,220. It's got that good feeling of setting higher lows and now setting higher highs. And so, yeah, a little bit of follow through here is going to be really productive for the market from a technical perspective. It makes a lot of sense when you start considering all of the external factors that are influencing gold right now. You've got the dollar at 6-month lows. Dollar is very close to entering more of like a bear market phase. Jump in a little bit there.
Yeah, so, it's worth noting that the bond yields are at about a 6-month low as well, and so it's indicative of less certainty about the Fed's tightening schedule. Right. It is still pretty much a foregone conclusion that they'll tighten by 25 basis points next week, but probability of rate hikes beyond the June time horizon have deteriorated pretty significantly amid generally weak economic data.
Right, and we talked about this a little bit in the last video too, that I find it remarkable that gold has really changed its tenor as it pertains to interest rate hikes. Even as we still sit here with June pretty much a foregone conclusion, gold has both become reluctant to trade lower on interest rate expectations, which I think is productive for it. It was always that was such a demanding narrative for the gold market, or commanding
narrative. Well, just look at how it traded in March. It did sell off in front of the March rate hike, but it did not make a lower low, as you suggested earlier. Yeah. And so we continue to have that trend of higher lows and higher highs, right. Which obviously is an uptrend.
Well, no, and it's quite good too in that if gold is not going to be as adversely influenced by interest rate jargon and Fed speak, then when you start to see, hey, maybe they're not going to be able to stay on track, or even if they do stay on track, it's starting to be more of an inflation expectation. So there's this great, dichotomy where the gold market is starting to view pretty much anything coming out of the Fed as more positive, which is a distinct change from what we'd seen in the previous 4 years. And I think that's one of the more measurable components of what we're seeing right now, why gold is charging at 1,300, with more assertiveness, I guess is what I would say.
Right. And the Fed speak over the last couple of weeks, they've been quiet this week, as they typically are right before an FOMC meeting. But in recent weeks, going back to the release of the May minutes, the Fed has been much more equivocal about that tightening. Their dots.
Exactly, and their schedule, and whether or not they're going to stay on schedule. And that's, as soon as you set one expectation, the market behaves a certain way. As soon as you start undermining that expectation, you can start to see things behaving differently.
Yeah, and I think they're not getting the results that they used to get. Right. That no matter what they say, whether hawkish or dovish, the stock market goes up and gold goes up, and they don't really want either of those things right now. So, exactly. Maybe being quiet is a good thing.
Yeah, well, maybe do we have a shift? Do we have a shift? It'd be interesting to see. So, but that's also in the broader context of everything geopolitical that is going on right now. It's just there are so many catalysts out there. From destabilization in the Middle East and the Korean Peninsula, to the election in Britain, which is proving to be a lot closer than it was thought to be.
Certainly, the polls suggest the more recent polls suggest that Ms. May's gambit is not looking all as surefire as it was
Well,
when
did
she
she
originally
call
called
the
it.
election
She
to
did.
kind of,
The idea was the Conservatives, the Tories, had a very distinct tailwind at that point, and she really wanted kind of a referendum on Brexit
Right.
at that point. And at the time, the Tories had about a 20% lead. They were expected to actually gain seats in the Parliament and kind of consolidate their position. That's not looking so sure right now. They may actually lose. She almost assuredly is going to be returned as prime minister, but they may actually lose seats.
Right.
So Labour may pick up a couple of seats, and then we'll end up with a hung parliament. And, well, not we, but they. Well, I'm not
the
British.
royal we.
Exactly. And so that may be problematic with advancing the Brexit timeline in the future.
Well, and it just all adds up to uncertainty.
Yeah, exactly.
Really. And then that's what we're seeing, kind of globally now is this uncertainty. And, it wraps into what's happening here domestically and going back even to our, long video on retail sales to how these numbers are starting to come out. Consumer debt is now become a really big issue again. And it's, all-time highs. It's basically, but this gorging of debt that's occurred over the last 5 years, and that a big swath of our, of the population that is in the lower income brackets has been relying heavily on such things, and cost of living is rising. No matter what they say about inflation, it's obvious it's occurring, in food especially. And so you're dealing with an environment where people have less and less and are still spending the same or more, and the net is an expansion of debt.
Right. Basically, the debt allows you to borrow prosperity from the future, but at some point, particularly in the middle class and lower income brackets, debt is finite. There is a point where people won't lend to you anymore based on your ability or inability to repay that debt, and so suddenly that gets stopped.
Yep.
And it's reflective of very sluggish consumption in general.
Right.
And with an economy that is 70% based on consumption, that's problematic for the economy as a whole, and that's why we've seen kind of below trend GDP growth since the recession. And that seems likely to continue. In fact, Bank of America said today that the bond market is telegraphing, the lower yields in the bond market is telegraphing significant economic slowdown.
Yeah.
And without the tailwind of the Trump agenda, kind of getting back to your point about what's going on here domestically, without that reflation agenda of deregulation and infrastructure spending and tax reform and so forth, all of which seems to have stalled at this point, then that becomes almost, in my mind, a surety that we're going to continue to see weak economic growth and possibly recession.
Exactly. And it all adds up and comes into a confluence to why, I think we're seeing what we're seeing from the gold market right now, and why things bode well. And, it's interesting that for years in the early aughts, the summers were what we called the summer doldrums, when the gold market was always really quiet and often traded lower. You could see significant increases in the gold price in the falls year after year after year, basically from 2002 to 2011, really. It was a pretty consistent theme, and so, but perhaps we set up this year, and this might be a really interesting and entertaining summer. So we will be following it. But to get to our golden gong, Incrementum, Ronald Stoffirle, they release an article, a report. It's actually much more of a report than an article. About 150 pages long every year. And it's called In Gold We Trust. We've covered this year after year after year. They do a wonderful job of covering everything about the gold market, every little nook and cranny you could possibly think of, every possible influence on the market. They cover it. It is an amazing thing to try to digest, but if you have the time, we highly recommend it. We're going to get it posted on our website like we do every year, so you can look for it there. You can also look for it elsewhere. I'm sure it's available.
Take it to the beach.
Take it to the beach. There you go. Exactly. But well worth the read. We're going to pull a quote from that kind of ties into what we were talking about today. Excessive global over-indebtedness is by now glaringly obvious. That not only applies to developed countries, but to many emerging markets as well. Moreover, all sectors of the economy are afflicted by huge debt burdens. Growing one's way out of this mountain of debt appears essentially impossible. The easiest way out of the situation would be a significant devaluation of the U.S. dollar, and of all other fiat currencies against commodities, primarily against gold. In this way, outstanding debt in fiat money terms could be made sustainable again. The consequence would be high price inflation rates or a stagflationary environment. A side effect would presumably be that gold's current undervaluation as a monetary asset relative to the total monetary base would at least decrease. Very fancy way of saying gold's going higher.
Golden Gong.
Thank you very much for watching. I'm Jonathan Casares.
I'm Peter Grant.
See you next time.